In this video, we're going to talk about the intricacies of trading with stock wedge patterns. And by the end of this video, I think you're going to have a pretty good understanding of how to effectively trade these patterns. So to begin with, we're going to talk about wedges, and it's really essential that you familiarize yourself with two primary types. We have rising wedges and we have falling wedges. So the rising wedges, they form when price action has two converging trend lines, but they signal different potential outcomes in the market. So the rising wedge, it's a bearish pattern, and that means that we may see a reversal in an uptrend or a continuation in a downtrend. And they are characterized by higher lows and lower highs converging towards a point, and it forms an upward sloping wedge shape. So think of it as tightening price action, with the price action resembling a cone shape as it progresses. And traders will look for a break through the bottom line, the support line. With falling wedges, it's generally bullish, suggests a reversal in a downtrend, or we can use it as a continuation pattern in an uptrend. We identify these by lower lows and lower highs converging in a downward slope. Just like we see with the rising wedge, the price narrows as the pattern develops. So you want to look for the trend line of support and resistance that come closer together as the price action unfolds. Okay, that's important. We're seeing lower volatility. So these trend lines act as a barrier, and I use quotes with that the price will struggle to break through. So it creates a distinct shape of a wedge pattern, like you would stick underneath a door. So the more it touches the trend line, the stronger the pattern tends to be when it breaks. So we're looking for a break of a resistance line here with this pattern. It's really important that you recognize the time frame, and this typically spans a few weeks to a few months for these to form. When you identify the time frame, you can better gauge the potential duration of the pattern. Plan your trading strategy around that. A falling wedge that took 3 months to form, that could signal a longer-term reversal into a bullish trend or a continuation compared to the one that only had a few weeks. So as you explore these patterns, you got to remember to practice identifying these on different time frames, different market conditions. The more experience that you gain looking at these, the easier it becomes to spot these patterns and capitalize when they show up. So first up is we need to determine the overall trend. That could be up or down, doesn't matter. We do this by observing the price action and looking for higher highs and higher lows. That's an uptrend. Or lower highs and lower lows. That's a downtrend. A helpful tip, you could use moving averages like the 50 or the 200 day. Smooths out the price action. Makes it a little bit easier to identify the overall trend direction. But remember, this pattern is a reversal pattern. This chart here, a 200 EMA, shows the current trend is up as the bearish wedge begins to form. So once you determine the trend, it's time to confirm whether that wedge pattern is signaling continuation or reversal. Again, a reminder, rising wedges are generally bearish, indicating either a potential reversal in an uptrend or a continuation in a downtrend. On the flip side, falling wedge, typically bullish, reversal in a downtrend or continuation in an uptrend. So for example, if you spot a rising wedge in the context of an uptrend, as we see here in this picture, it could be signaling a potential, check out those words, reversal to the downside, where a falling wedge in a downtrend could indicate an upcoming bullish reversal. We don't know. So to increase your confidence in the higher probability outcome, incorporate maybe different technical tools like oscillators or support and resistance levels. These tools will help you confirm the validity of the pattern and could provide you further insight into the direction that this price could go. For example, if you notice that a falling wedge has formed near a strong support level, well, it could reinforce the likelihood of a bullish reversal. Analyzing the market context, it's vital in trading with wedge chart patterns or anything. If you can determine the prevailing trend, you can confirm the wedge pattern as a continuation or reversal, you're going to be better equipped to make better trading decisions. Talk about volume. You monitor trading volume, somewhat of an important aspect when you trade patterns. It can provide valuable insights into the strength and the reliability. So, simply put, volume represents the number of shares that's in stocks or contracts and futures. Trade it within a specific time frame and can help confirm the legitimacy of price movement. So as the wedge forms, we want to see decreasing volume. This contraction in volume, it's a natural consequence of the converging trend lines because price is narrowing and then market participants become a little bit more indecisive. So decreasing volume indicates the market is consolidating. That sets the stage for a potential breakout. So in a healthy wedge pattern, you'll often notice that the volume is highest at the beginning of the pattern and begins to taper off as the pattern develops. When that price finally breaks out of the wedge pattern, you're going to want to see increasing volume to confirm the breakout. especially after the break. So I want you to notice the volume is below the 20-day average volume a lot of times here. Now we see an obvious increase in volume once that lower trend line is broken. So a surge in volume during the breakout, that can suggest that market participants are actively buying or selling the asset, depending. That adds conviction to the price movement. So if you see a falling wedge pattern in a downtrend on decreasing volume, followed by a breakout to the upside with a spike in volume, that's a good thing. That reinforces the bullish reversal signal and increases the likelihood of a successful trade. So listen, here's the thing. Significant increase in volume, yeah, that's a strong confirmation. But the absence of a volume surge at the breakout does not necessarily mean it's going to be a bad breakout. That breakout could still be valid, but it could lack the momentum for a sustained move. But you could also see volume pick up after the break. All depends. We can use indicators. It can help your ability to trade these patterns effectively. You can get some pretty decent insight into price action, can confirm reversals or continuations. So one useful set of technical indicators, oscillators, we can use those, such as the RSI or the MACD or stochastics. They help you identify overbought or oversold conditions in the market. That could signal an impending reversal. It's not guaranteed. So if you spot a falling wedge pattern in a downtrend and you notice that the RSI is showing oversold conditions, it could strengthen the bullish reversal. So to use any indicator effectively, you really have to understand the mechanics of them and how to interpret them. So here, the RSI typically ranges from 0 to 100. Readings below 30, people considered oversold, 70 overbought. That's just generalization. People change those around. The MACD is actually based on the distance between some moving averages, and it generates signals through crossovers with its signal line. The stochastic, that compares the current price to a price range over a specific period that you can set. And it generates signals through the crossovers and overbought or oversold levels. So another important indicator is moving averages. They can help gauge the overall trend direction and the strength. They smooth out the price action. They make it easier to identify trends and potential support or resistance levels if you look left. So commonly used averages, they're the simple moving averages and the exponential. There's other ones, but these are the most popular. You can experiment with different time frames, the 50-day or 200-day. Whatever it is, just find one that suits your trading style, your time horizon to be in a trade. So let's say you're analyzing a wedge pattern in an uptrend and you look at the 50-day moving average to see if it's acting as potential support or resistance. So if price breaks below the average and the wedge pattern at the same time, it could indicate a stronger bearish reversal. When you use indicators like oscillators and averages, it can improve your ability to trade these patterns. When you apply them properly to confirm or just to add other variables, you're going to be better equipped to make better decisions as long as you don't overdo it. We have to establish entry points. It's really important. A well-defined entry point is going to increase the likelihood of a successful trade. It's that simple. So we can do a confirmed breakout. So we wait for the breakout before entering a trade. This just, again, when price closes above or below the trend lines of a wedge pattern. This breakout signals the market's made a move and the pattern has reached the conclusion. So for example, you're trading a falling wedge, you would wait for price to close above the upper trend line before considering an entry if you're looking at a reversal and not a continuation. We can toss in a price filter, very important. This is either a price-based or a percentage-based filter. It requires that breakout to move a specific amount beyond the trend line before you get into the trade. This can help filter out those breakouts that fail, quote, false breakouts. So let's say you're trading a stock. You might require that price to move at least 10 cents beyond the trend line before you enter. Percentage-based, obviously price will have to move a certain percentage beyond the trend line. Now that method can be useful when you're trading assets with varying price ranges because it does account for the asset's volatility. So for example, you're trading a stock with a high degree of price movement. You may require a 2% move beyond the trend line before considering an entry. Using the ATR, the average true range indicator, my favorite, you can use a filter that's a fraction of the average true range of the instrument. So let's say a stock has an ATR reading of $4. Traders may use 5% of that or 20 cents. Price would have to go up 20 cents before they get into the trade. So establishing entry points, vital step in trading patterns. By waiting for the confirmed breakout, considering the use of price or percentage-based filters, you're going to increase the likelihood that this trade may work out. Stop loss orders, one of the most important things you can do. A well-placed one can minimize your losses in case that trade doesn't go as planned. And it can help you secure profits as the trade moves in your favor when you're looking at it as a trailing stop. So where do you want to place your initial stop? Say it's a falling wedge pattern. below the recent low is good, or above the recent high for a rising wedge pattern. When you do this, you give the trade room to breathe, but you also protect yourself from significant losses if that price reverses. So here, you're trading a falling wedge pattern. You go long after a confirmed breakout. You place your stop loss order below the recent low within that pattern. Trailing stop losses, something to consider. These will help lock in profits as the trade goes in your favor. It's just simply, if you don't know, a trailing stop loss, it automatically adjusts as the price goes in your direction. That means you capture a portion of the gains if the market reverses. And there's so many different ways you can do it. You can trail your stop around a moving average, swing lows, swing highs. You can use ATRs, the chandelier exit, or just simply use X number of bars behind the current price. And when you set stop losses, I'll be honest, it's much as an art as it is a science, because you got to strike a balance between giving the trade enough room to develop and not risking too much of your capital. And as you get experience and you get used to your strategy, you're going to become better at determining the best stop loss for your strategy. It's that simple. Profit targets, got to figure them out before you get into trade. Where are you going to get out? Because it enables you to create a solid exit plan. Make the most of the potential earning that could happen. So having a clear profit target also helps you maintain a healthy risk-reward ratio. Doesn't mean you're always going to get that reward though, but that does play a role in achieving long-term success. So to set a profit target, you could just measure the widest part of the wedge pattern. This is typically the distance between the upper and lower trend lines at the beginning of the pattern. This is going to give you an approximate price target. You can use that to project potential gains from the trade. And again, it's not an exact science, but it is a pretty decent reference point for your profit target. Next, you would apply that measured distance to the breakout point. And that breakout point is where price broke through the upper or lower trend line. By adding the measured distance to the breakout point for longs, subtracted for shorts, you can project a potential price target. So for example, if the widest part of a falling wedge is $16 and price breaks out at $105, your target would be $121. It's 105 plus 16. Set a take profit order. Pretty simple, based on projected targets. It would automatically close your position when price hits it. This ensures you lock in your gains. You don't let a winning trade turn into a losing trade just because the market did a sudden about face on you. Now, remember, it's projected target. It's an approximation. So you got to monitor the trade. You have to adjust your profit orders as needed, all based on what price is doing. Let's wrap it up. It's a pretty powerful tool when you trade it right, when you can identify it, you can analyze the market context, you can watch the volume, maybe add a few technical indicators to it. You have your entry points, your stop loss, the targets. You can manage your risk. You're going to be well equipped to capitalize on this pattern. But it's important to remember, just like any trading strategy or approach, success is going to come from diligent practice and your continuous learning, right? You're never going to end. So you got to stay committed to refining your trading skills. Then you'll be on your way to harnessing the full potential of these patterns or anything else you're trading. When we talked about indicators, we actually have a price pattern trading guide. A lot of people use indicators, right? But learning how to use price patterns, for me, it's been a game changer. It's a free guide, helps you find ideal entry points. The link is to the left, link is below. You should grab this guide. We may stop giving this one away. It's been one of our most popular giveaways. Anyways, thanks for watching.